It's undeniable that the LP community is looking at the venture community and saying that the math is broken. To put some data behind this, a recently released report from McKinsey showed that global commitments from LPs to venture managers has shrunk from its peak of $330 billion in 2021 to $100 billion in 2024. Now, why? Why is that happening? There's a couple of reasons for this. The median for venture returns is now failing to keep up with the returns of public markets. In fact, last year, if LPs were overcommitted to public markets, their performance outran that of their peers who had been committed to those of private markets. And the result is that LPs are doing what they have to do what's right for their constituencies, which is putting assets and making investments into higher yielding asset classes. The median returns for venture are not sufficient to keep up with those of public markets. Does that mean I shouldn't invest in venture? No, quite the contrary. And why? Well, the answer is that while the median return for venture has not outrun that of public markets, top quartile returns have continued to outperform those of public markets, and frankly, more than just about any other asset class. The top performing venture capital funds continue to put up 4x or better returns. The problem in venture is that unlike other asset classes, the dispersion of returns is greater than just about any other asset class. In fact, you can see that the dispersion ranges in venture from a bottom quartile of 1.5x to a top quartile of 4x, meaning that there is a massive difference between who it is that you've invested in. Which venture manager are you investing in? The other thing that has emerged is that there is a greater persistence of venture managers who get into the top quartile to repeat that performance on a vintage by vintage basis. Now, this is in stark contrast to other asset classes, other alt asset classes like private equity. Private equity has a much tighter dispersion of returns. You're going to see funds in the 2 to 2.5x on a very, very consistent basis. But you're going to see less consistency of private equity firms in that top quartile. Firms will consistently rotate in and out of the top quartile into the bottom quartile, but if they're in the bottom quartile, they're still producing a return that is going to be relatively attractive for LPs. So in venture, what has emerged as interest rates have spiked and pressure has come on venture firms is that all venture firms are not created equally. In fact, there is a massive difference between top quartile and bottom quartile. Now, what are the drivers of that dispersion of those returns? In our opinion, there's a couple of things. The first is that you're going to see a large degree of variation by vintage. For the last 15 years, what we've really been investing in, if you oversimplify it, is we've been investing in two platforms. We've been investing in mobile and we've been investing in cloud. These two inventions have persisted since 2007 and have created the disruption necessary for a robust venture environment. So firms that have been investing in those technologies and those platforms and at the forefront of that have been able to perform at the higher level. The second thing that you found is that venture firms who have a differentiated approach are actually the ones who are using that differentiated approach to be the driver of their returns. Drive Capital, obviously, our differentiation is that we invest in a corner of the world. We invest in American innovation as opposed to just the California innovation. It's harder to invest in this place. It is a bigger geography. There are fewer venture firms who are here. And so the result is that we have a competitive advantage. Other firms have a similar differentiation, maybe through a different method. Sequoia is differentiated by being in Silicon Valley for the last 50 years and being the dominant firm. Firms like Signalfire are differentiating based on a very data-driven approach. Lux Capital have differentiated by investing in a deep technology. Firms like Union Square have differentiated by going very early and starting out of the New York ecosystem. What you're going to find is that the firms that have this differentiation, they're able to take advantage of that and use it as a way to drive outperforming returns that are going to be top quartile. So what we are encouraging LPs to do now is to just understand that venture is not necessarily an asset class. It's necessary to do the work to push down one level, to understand the differentiators between the top firms and the bottom firms, and to understand what the drivers of theirs are going to be. And the LPs who have done that are still consistently seeing their returns come in a way that is favorable to other asset classes. Another reason that LPs are soured on venture right now is because distributions have all but dried up. Now, why has that happened? Well, there's a couple of reasons for this. The first is that there have been many companies that have been able to achieve massive valuations in the private markets that they could not replicate in the public markets. The result of this is that companies choose to stay private longer because they want to continue marking up their values, and they're not going to do that until they can get into a position where their public round valuation is going to be at a premium to their last round's private valuation. Now, some companies are taking this on the chin. You've had companies like Klarna that have achieved a $40 billion valuation, opting to then raise a follow-on capital at a substantial discount at a $6 billion valuation in the private markets, and then close subsequent rounds at up-round valuations at $10 billion. What's holding these companies back is that few companies have done that hard medicine look at their business like Klarna has. But as soon as companies start to get in the realm of seeing premiums in the public markets to what they would get in the private markets, you'll continue to see this pipeline of companies get public. Notwithstanding that, however, what you're seeing is that an enormous amount of volatility driven by current events, news media, tariffs, a whole bunch of things are going to make it ever harder. So we don't actually see IPOs returning anytime soon to this market. So the next question you might be asking yourself is, where will liquidity come from in venture market? Public markets are facing the volatility, they're facing a valuation headwinds, things that are very, very challenging to work through. The other thing you're going to run into, though, is that the exits are going to come from strategics and from private equity firms. Well, private equity firms and strategics, they tend to be very disciplined on the prices that they pay for things. It's very unusual to see a company acquired at a massive premium to where a public company might trade. Private equity firms are very disciplined about where they buy things. They need to buy things in a way that work with their financial capabilities. So the result is that we foresee in the near future is that valuations and liquidity events will be fewer, farther between, and that those valuations will be at a substantial discount to where many of those private rounds have been held. Does that mean there's not going to be any liquidity? No, it doesn't mean that at all. It means that the liquidity will come from venture firms who have invested in companies that have produced very strong financial fundamentals and have been able to achieve a scale at which the outcome will be at a premium to where they were most recently valued inside of their portfolio. Drive is an example. We continue to send more distributions back to our LPs this year, and we're on pace this year to distribute more money in 2025 than we called, which will make us distribute more money in 3 of the last 5 years, 5 of which have been very, very challenging years to our LPs, than we have called from them. But those distributions are coming from smaller trade sales that are in the portfolio that are happening at $600 million valuations as opposed to $6 billion or $600 billion valuation. As a VC, this is really important to us. Our product that we are producing for LPs is returns. And in our view, it's our job to produce returns for you in down markets as much as we do in up markets. What's going on right now with artificial intelligence is the promise of the next platform. Like I said earlier about cloud and mobile, what we're seeing today now being replicated with the potential of AI, we're seeing real businesses that are building hundreds of millions of dollars in revenue profitably, cash flow positively. The promise of this technology is that technology platform that will persist for the next 15 years. Venture capital is something that I work on every single day. I'm incredibly passionate about it. And when markets cycle up, it's easy to see people's enthusiasm, and that enthusiasm is shared. Right now we're in a down cycle, and I understand why there are fewer people who are as enthusiastic about it as those of us who are committed to it over the course of our careers. But I continue to be committed to it. I continue to believe in the long-term potential of investing in the innovations of tomorrow and using that innovation as a way to generate returns for LPs that are going to be better than anywhere else you could invest your money on the planet. Now, this is our opinion. This is what we love to do. We're admittedly incredibly biased. So to the degree you have comments on this, questions on this, please reach out. We'd love to hear from you.